Did you know that a financial expert has cautioned against purchasing Tesla shares? Even seasoned investors take the advice of experts seriously, so it's in your best interest to do the same. Investors are frantically trying to hedge their bets against impending inflation and recession, and the stock prices of many companies, including Apple, Google, and Tesla, have been volatile. Find out in today's video why experts are advising against buying Tesla shares right now. As the industry leader in electric vehicle production, Tesla is helping to hasten the global shift to renewable energy sources. Solar power systems and renewable energy integration, new safety and car emissions rules, technology advancements, and changing consumer expectations are just a few of the reasons Tesla has become famous. Sales for Tesla will easily surpass $50 million in 2022 compared to the previous year, even with the challenges in the supply chain. Although CEO Elon Musk expressed gratitude earlier this year for the increased output from both existing plants and new ones, Morgan Stanley expressed concern over the Berlin factory. Morgan Stanley is a global investment bank and financial services provider based in the United States. The firm assists individuals, organizations, and governments in acquiring, allocating, and working with capital. Due to supply chain concerns, they cautioned that Tesla manufacturing have been operating below capacity for multiple quarters. Dan Nathan, principal of Risk Reversal Advisors, which offers consulting services to investment banks, investment advisors, and private companies, recently shared his stance on buying Tesla stock when asked if he would be buying Tesla. Since he mentioned that he is nibbling on the triple Qs, he answered, "Nope, nope, nope." He explained that he, like others, do not know what is going on with the deal. He added to say that he actually hates the fact that it is a top 6 name in the Nathan believes that it is going to eventually drop out of that rank in the future. He added that he thinks that Tesla stock has a lot of room to run, and that a large part of the premium in the stock is because of Musk's present aura, especially given his controversial stake on Twitter. Nathan personally believes that it is a huge mess since Musk wants to buy Twitter but can't afford to buy it since Tesla's stock price keeps going lower. In fact, experts warned that although Tesla stock's valuation is getting closer to reasonable levels, it may not stay there for long. Dan, while Elon Musk is the wealthiest man in the world, Nathan informed Molly Jong-Fast of New Abnormal that the $44 billion needed to acquire Twitter would be too much for him to pay. To make up the difference, Musk plans to sell some of his Tesla shares and bring in more money from private equity and venture capital. According to Nathan, the problem is simply the stock is not worth $43 billion when all of its public comps are going much lower every day on the NASDAQ that's careening lower, which is down about 27 on the year. He added that it makes absolutely no sense to pay that unless Musk thinks he can take it private and have some really smart co-investors with him and retool this thing, and it comes out as a $100 billion business. However, he continued to say that without Elon, if he is in fact no longer interested, and if Tesla goes too much lower and Twitter's value sticks out like a sore thumb being weighed overexposed, all of those private equities and VC people who've lined up to co-invest with him will be gone if he's not there, since part of the allure is riding his coattails. According to Nathan, everyone thinks he's brilliant and can solve all the major problems. It may be recalled that Musk tweeted about whether he should sell Tesla shares to pay taxes. Shortly after, he tweeted again about whether he should sell Tesla shares to buy Twitter shares, which caused the stock to decline. This is a major concern for Nathan, who believes it's all a hoax and that Musk used it as a pretext to sell a lot of Tesla shares, which he did when he began selling last fall. What are your thoughts on Dan Nathan's warning? Drop a comment telling us what you think. From a corporate good governance perspective, Tesla has a lot of red flags, said Andrew Peretta, a senior analyst specializing in socially responsible investing at Sage Advisory Services, an investment firm in Austin, Texas. Even longtime Tesla optimists like Daniel Ives, an analyst at Wedbush Securities, are beginning to have misgivings. He proceeded by saying that there are practically no checks and balances. A recent reduction by Wedbush from $1,400 to $1,000 was their target price for Tesla. I have mentioned Tesla's issues in China, where supply of vital parts and materials has been limited due to lockdowns, while demand for cars has been on the rise. However, there is a new reality for Tesla in China, and the market is reevaluating the dangers. The chief executive of ZozoGo, an electric car industry advisory firm, Michael Dunn, recently warned that falling demand from Chinese consumers is exacerbating supply chain problems in the country. Dunn characterized Chinese consumers as anxious and fearful about the future, adding insult to injury for Tesla. Dunn exclaimed, according to chief analyst Jess DePrack, an experienced auto industry professional and chief executive officer at subscription electric vehicle provider Autonomy, Tesla's market share will drop below 40% by the end of 2023. DePrack predicts that sales will keep growing and that the company will maintain a similar percentage of the overall market, but that their near monopoly on EV sales in the US will gradually dwindle. This prediction is based on the fact that Tesla is already facing tough competition in Europe, where electric vehicles make up just 13% of new car sales. This bodes well for the United States, where sales of battery-powered cars are just starting to take off. Schmidt Automotive Research in Berlin reports that in the first 3 months of the year, 56,000 battery-powered cars were sold in Western Europe by Volkswagen, a company that has made significant investments in electric vehicles. Tesla sold 58,000 cars in the same period. Some prominent investors are reportedly freaking out over the continued decline in Tesla stock. Among the many serious concerns voiced by those who are considering buying Tesla vehicles is the fact that the company's vehicles are still prohibitively expensive, both for buyers and manufacturers. Tesla's world-renowned Gigafactory, which is currently under construction, is intended to resolve the company's battery predicament. But once again, the executives at Tesla have fallen into the problem of not having enough batteries to power their products. It is uncertain whether the lithium-ion manufacturing plant, which has a planned footprint of over 1.9 million square feet, will be able to be finished on time. But it is expected to assist in increasing production to over 500,000 Tesla cars per year. Even Musk has dropped hints that the Gigafactory, which is still under construction, and other facilities may be necessary for the firm to fulfill demand. Low gas prices pose an additional risk to Tesla's products due to the prevalence of gasoline-powered vehicles. Petrol prices need not stay at decade-low levels to harm Tesla stock prices. They need only be low enough to maintain the purchasing power of consumers who are less inclined to switch to electric vehicles, so long as petroleum-based fuels are substantially more affordable. Even if Tesla is supposedly the market leader in electric vehicles, the rising level of competition in this industry is a factor that impacts the stock price. In the coming years, several firms, such as Mercedes-Benz, Volkswagen, Subaru, Ford, and BMW, want to join the electric car industry. There might be some competition for Tesla's market share if this occurs. Some tech companies may also decide to get involved. Apple Incorporated, for example, thinks it can take on Tesla in the transportation market. Google has also put money on the car industry. Some people are worried that Tesla won't be able to recoup its massive expenditures, since Musk has said they'll be spending a ton of money on capital expenditures. A large number of investors would rather see large capital expenditures, but there must be a return on investment. In a quarterly SEC filing for the first quarter of 2021, Tesla predicted that capital expenditures will probably increase to $4.05 or $6 billion annually. Elon Musk's contentious nature as Tesla's CEO has caused some investors to worry. Musk has stated in a note that he does not give Tesla his undivided attention. The spontaneous actions of Musk also have practical repercussions. In an earnings call with Tesla investors, Musk spread false information about the pandemic and called lockdown restrictions fascists. Musk's recent announcement of plans to buy Twitter has also worried Tesla investors, who worry that Musk will eventually lose interest in Tesla. For more Tesla stock content, check out our other videos.